Welcome to part two of this series of recordings coming from our private high net worth team at Baker Tilly. My name is Andrea Satiri. I'm the Global Head of Tax at Baker Tilly International. And again, I have with me today Nigel May from our UK member firm, Alison Wood from our member firm in Australia, and Ian Halligan from our member firm in the USA. In part one of this series, we explored how COVID-19 is changing cross-border tax planning. And one of the issues we touched upon was residency. And what we'd like to do in this second part is explore residency a little bit further, quite cheesily entitled Residency, a Taxing Issue. We want to pick out the myths, the facts from the myths, and we want to highlight just how much the rules can vary from one territory to another. So I'd like to hand it over to the panel. Nigel, I'm going to come to you first because it's a particularly prickly issue in the UK. It's changed quite a number of times over the last few years. I still remember where we had ordinary residents as a rule here as well. Thankfully, that disappeared a number of years ago. But if I can hand over to you first to ask you to unpick some of the things that we know.
Well, Andrew, the history of residency for tax purposes in the UK is quite sad. In 1939, it was decided that it would be a good idea to have a statutory set of rules for residency, and we got round to it by 2013. The rules are difficult to deal with is an understatement. We have concepts of definitive UK residents, definitive non-UK residents, and for people who fall between those two, we have what are called linking factors, and things like, do you have a home available to you, where's your family, etc. And the number of days that you can spend in the UK depends if you're in that in-between land between definitive and definitive UK residents and non-residents. The number of days you can spend depends upon the number of linking factors. You then have to take into account, are you dealing with someone who's leaving the UK or coming to the UK? And then the UK rules define residence by reference to the tax year. And there are only very limited situations where someone who's coming to the UK or leaving the UK during the tax year can sort of have what's called split year treatment. So it's been kept deliberately complicated because I think the UK government were of the view that if we had a simple day count test, it would be too easy to avoid tax by planning.
Can I ask a further question on that? You referred to the split year treatment. Is that a good thing or a bad thing for taxpayers?
It depends upon the circumstances. I mean, certainly there are instances where, say, for example, you're dealing with someone coming to the UK, and let's say someone coming to the UK from Australia, and they have made a disposal, let us say in June 2021, and they're coming to the UK. Goodness knows why they'd be coming to the UK from Australia, given that the comparative COVID thing and the difficulties of coming into the UK, but that's another thing altogether. But you would want to have split year treatment so that, say, the disposal before they had come to the UK did not fall into a period of UK residence. So split year can be really very important, but actually more important than that, getting your planning right from a viewpoint of try to plan, if you're coming to the UK on a tax year basis, is just far safer than trying to rely on the limited circumstances where split year applies.
So I want to come to you, Ian, now. I mean, we've heard that how complicated it is in the UK. Is it the same sort of situation in the US? What are the rules like there?
Yeah, there's different complexities, Andrew. I've been in the States 20 years. We really haven't had a lot of changes to the federal residency tests, but we've got to consider not just the federal position, but also the states as well. And there's not symmetry between those two approaches. So You know, the US is probably one of the few countries left in the world that taxes still on a citizenship basis. You know, you can live in another country for the entire year, but if you're a citizen of the United States, you're still a tax resident here. Green card holders get similar sort of treatment. And then we do have a substantial presence test, this sort of days counting test over the last 3 years that can give you residence. But, you know, once the US has got their sort of tax hooks into you, it's difficult to extract yourself. We have an exit tax that can come into play where citizens and certain green card holders relinquish their status, that can treat you as, you know, selling all your assets on the date you leave. And to Nigel's point, we have transitional years, you know, years of arrival, years of departure, some rules around that can potentially be fairly complex. So yeah, depending on the situation, circumstances, the state you're in, the state you're leaving, you know, there can be a whole host of factors that come into play and need to be addressed. And yeah, obviously during the pandemic, in this COVID world we live in, people have accidentally tripped over these things from a state perspective, from a federal perspective, from both. And yeah, it's caused some heartache in certain situations. Now, the interesting part, you know, and I think this applies in the UK and Australia, but I'll certainly defer to Alison and Nigel, is from our estate tax perspective, it's not an identical residency test. So when you look into things from an income tax perspective and residence there, you may not end up with the same answer from an estate perspective. And that can lead to, again, you know, potential pitfalls, but also planning opportunities when we're looking to structure things and exit people out of the United States.
That's such an interesting point you've touched on there, Ian. And Nigel, I want to come back to you in just a moment on that as well, just to understand the UK perspective of it. But I'd like to firstly hear from Alison with regards to residency in Australia, and also on that point of how does it impact different taxes?
But it does, and we're perhaps a bit more on the forefront because our federal budget only last week announced a massive bright line 183-day test, which the devil will be in the detail, no doubt, because there are also some other criteria that we need to think about. But unlike the UK and the US, we have a very subjective test, particularly for people, Australians trying to leave and break residency. And it's all about where you reside in the normal course of the word. So it's quite complicated, and you can have individuals leaving, perhaps to slightly different jurisdictions, but their fact pattern can be almost identical, and they can have different residency status, which is incredibly frustrating. For those coming in, it sort of got a bit easier in 2006 when we developed a temporary resident, so a sort of a halfway resident. But even that's very confusing because it depends very much on what visa you're on and whether it's a permanent visa or a temporary resident visa, or it depends whether you're coming through the back door via New Zealand. That has a big impact on Australian residency. But of course, we don't have currently, touch wood, death duties or gift taxes. There are some backdoor capital taxes when it comes to people passing away, but we do have a deemed disposal of assets that aren't Australian for residents who break tax residency of Australia. So, but then we have to look at the various treaties, because some of the treaties, so the treaty with the UK would say that we don't have to deem dispose, and there is a choice. Taxpayers can make a choice to elect not to deem dispose. And I think that goes to the point. It's a double negative, which is always confusing. Why elect not to deem dispose when you could just elect to dispose? I think that leads to the complexity and the subtle differences with the English language.
So Nigel, coming back to you, could you talk us through how the concept of residency impacts the income tax and the different capital taxes? Is it a broad brush treatment, or are there nuances between the different taxes?
Well, certainly you have to remember that we rely on the dual concept of residence on the one hand and domicile on the other, and domicile is a weird and wonderful set of rules that bears no relationship to the normal English language. But for people who did not originally derive from the UK, non-domicile status carries with it certain advantages, and that non-domicile status will be very important for non-UK people coming to the UK, particularly from a death duty viewpoint, from an inheritance tax viewpoint, because someone who is not domiciled in the UK is only liable to UK inheritance tax on UK situated assets. So there are deemed domicile rules now under which if you outstay your welcome in the UK, you will join the UK tax club good and proper. But there are also rules under which for UK expats who have left the UK for very many years and have established non-UK domicile elsewhere, if they find themselves UK resident, they can get themselves into very great problems from a capital tax viewpoint. Income tax, again, the non-domicile rules allow remittance basis to apply. So for foreign source income, you are able to pay tax only on income that you bring into the UK, either directly or constructively. You have to be very careful about that. But again, the rules are hideously complicated. Fortunately, you know, for most individuals, unless they've got substantial wealth, probably the rules would not be too impactful. But if you're dealing with a situation where you're dealing with high net wealth or ultra high net wealth individuals, getting your domicile status and how you deal with domicile status right is really very important.
So I think that's an interesting point on you know, the thing that comes up with the clients the most for me in terms of like their misunderstanding of how taxes work are things like these differentials between the approach from domicile versus residency and how that can impact income versus inheritance tax. There's also, and I understand why, there's also this concept of, you know, there's this bright line in the sand where you cease to be a UK resident but become a US resident. And as we both know, there can be gaps of time where you're a fiscal nomad and you're not resident anywhere. There can be periods of time where you can be resident of 2 jurisdictions at the same time. And I think that, you know, that there's this concept that international tax all works together and everyone's on the same page and is applying the same rules. And that's really where the planning opportunities are. And conversely, where the real, you know, the real danger zones can be from a dual taxation perspective.
Well, one of the major differences between corporate tax and personal tax in the UK is that a treaty definition of corporate residence will be determinative of corporate residence. But from a UK viewpoint, from an individual viewpoint, you may well be, let's say, Portuguese resident under a treaty, but that will only give you limited protection, only the protection that the treaty actually avails. And so you can be in, as you say, Ian, you can be worldwide non-resident, you can be dual resident but treaty resident. There's all sorts of different permutations of what the outturns can look like.
And it can lead to some nasty tax outcomes. I mean, we don't have a separate capital gains tax. All our capital gains is just concessionally taxed by virtue of a 50% general discount, but it's subject to tax under income tax. So where jurisdictions like the UK and the US have a capital gains tax rate, our foreign income tax offsets are effectively halved because it's applied to the what we would call the gross gain before the general discount, which, you know, can be very, very expensive and a difficult conversation to have with clients because they've paid 25% tax in the UK and expect that, you know, there's no additional tax to pay in Australia if they're subject to tax here on a worldwide basis. But actually, no, they almost lose half of that 25% tax credit because it's applied to the gross gain, not the net gain. And that's purely because we don't have a capital gains tax act. We call it capital gains, but it all comes under income tax. So those subtle differences can be very painful in the hip pocket.
It is those subtle differences, Alison, because it's definitely a case of, like, in our international tax world, it's the mismatch that always causes the problems, right? It's, you know, when there's a mismatch in timing of income pickup or expense deduction, where there's a mismatch in terms of this entity's treated as a corporation in country A, but a partnership or a flow through in country B. That's when we really find we run into some issues.
I think one of the recurring themes from international tax planning perspective is there is a presupposition, because you know the rules in your country, that you will assume that the other country will have come to a similar conclusion, and that's anything but the case. You know, the point that Alison brought out, you know, I mean, it's logical, but I would never have thought that you could have that context. We have the same issue, say, for example, where with UK, US, where you've got corporate entities where you've checked the box to treat them as transparent, and there's no equivalent rule in the UK. So it creates all sorts of issues that no one would have intended. Surely no one would have intended, but you end up with the tax rules really not fitting what the set of circumstances are from a cross-border perspective.
Right.
It'd be interesting, won't it? With the COVID pandemic and coming out, every jurisdiction around the world coming out with massive deficits as to internationally mobile families and high net worth individuals. They're not going to have a vote. They're not going to have anything like that. So, you know, it'll be interesting to see in future budgets when, I mean, I think all three jurisdictions are sort of throwing money at people to keep local economies going at the moment, but that can't continue forever. One would have thought. Otherwise, our children and grandchildren are going to be in a considerable amount of debt going forward. So I think that I would expect there, and I mean, in Australia, we've had a Board of Taxation review of residency issues, and they know that they need to sort of wipe the page clean and start all over again and put some more rigor around it. But that was March 2019. And, you know, the most exciting thing we got was the federal budget last week saying a bright line test of 183 days. But that was the least of our worries from a tax advisory perspective, I think.
At the risk of schadenfreude, I suspect, Alison, that it will be our children and grandchildren who pay for the past 15 months in any case, because of the consequences of raising tax to cover the international government spend. It just doesn't bear thinking about.
Well, Nigel, I will say this. We're expecting a pretty hefty tax increase here in the States. We just don't know what form it's going to come in. So I think I'm going to at least pay for some of my kids' and grandkids' deficit. So, but more power to the two of you if you don't have to.
We're not seeing it at the moment.
Sorry.
We're not seeing tax hikes at the moment. In fact, they've got a plan to actually increase the thresholds and reduce some of our complicated tax. We have 4 or 5 different tax rates. There's a plan out to 2025, but it all depends on what government's in. So
I want to thank all three of you for joining us again today. I think there's a couple of really key takeaways our listeners can cream from this. I think the first key one is the rules are different from one territory to the next, and we've only seen 3 examples here, and every territory is different. And again, what's really clear is that there's no synchronizing of these rules across borders as well. So that's a common misconception, as a couple of you have highlighted as well. So I guess we strongly advise people to seek help from advisors at the earliest opportunity if they suspect there's a problem around the corner.
Andrew, look, one key point is the earliest opportunity means several months before you want to be doing something. The earliest opportunity is not like 2 weeks before you're going to you know, to get your ducks in a row from a residency viewpoint. It does take time, and it does take advice. It does take advice quite often from a multiple jurisdiction viewpoint. So, you know, like 12 months would be good.
Excellent. You heard it here first, 12 months. Thank you very much, everyone.